Good day, Industrial Advisor listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. We have Bill Condon and Matt McGregor, and today we have Stephanie Rodriguez joining us. Stephanie is the leader of our industrial practice, so National Director of Colliers Industrial, and Stephanie joined us in October of last year, and prior to that was at Duke for 15 years, running the Florida market for Duke. And I will say that, since Stephanie's been here, she's just doing an outstanding job. I know, Stephanie, you're traveling a lot, seeing different offices. You're in touch and plugged into all of the markets across the country, but you've done a great job since you've joined us, and we're super excited to have you leading the practice.
Well, thank you. And thanks for inviting me on your great podcast, which I listen to while on airplane, by the way.
Awesome.
Nice.
Yeah.
Well, thanks for being on. Tell us about this last year. What have you been up to? What have you learned about, Colliers and just the transition? What has it been like for you?
Yeah, it's been a whirlwind, honestly. So I left my office on a Monday with Duke Realty after 15 years of a great run. And on Tuesday, I moved into my office in Miami for Colliers. And then Wednesday, I flew to Austin and we had our National Industrial Conference. So nothing like your first day of work being in front of like 700 people.
Right.
But no, it's been really great. I've been trying to immerse myself in the platform. I was a client of Colliers before coming to work here. So I knew a lot about the company just because I saw it from another side. And I had a great experience working with Colliers over the years on, with brokers who represented tenants and also brokers who, handled some listings and brought us sites for development and things like that. So I had a really good basic understanding of the level of professionals who were here. Felt like it was going to be a great fit for me, but I think I was most surprised by how great a fit it was. I never expected to be in a role like this, for one. I didn't expect to just really hit the ground running as quickly as I did, but just so many great people behind the scenes that, everybody's familiar with faces like yours because you're out there, you're interacting with the clients every day. But we've got so many awesome professionals behind the scenes who kind of helped me get settled in very quickly. And then just spending time in the markets with the clients and the brokers that I get to partner with has been extremely fun for me. So I've just been enjoying the ride.
That's awesome.
Your travel on a lot of planes.
Yes, I was going to say your travel schedule has been unbelievable. So hopefully you get to take a little time off in the summer and cool that down, because you've been impressive how much you've been on the road.
Well, it's been fun.
So as you've kind of traveled around the country and as you've talked with different clients, both, on the occupier side and on the ownership side, what are some of the trends that you're starting to see or have seen of late?
I would say everybody's become a lot more analytical. For a few years, especially recently, both on the developer owner side and on the occupier side, it was sort of like you just had to make decisions very quickly. And we were just trying to keep up with demand. And everybody sort of did a back of the napkin or a sniff test or a gut check, and they were moving forward. Now it's much more data driven. People are really taking the time to analyze, exposure and risk. And is this a good decision to make? And that's on both sides of the table, from the owner investor side to the occupier side. So people are just really being a lot more analytical and really making sure that they're making a good decision.
Yeah, we're certainly seeing that with our clients as well. There's a lot more of that. And I think part of that has to do with, the overall economy, but also kind of where debt has gone as well. Just some more caution out there, I guess I would say.
Yeah, for sure. I mean, I think it's not a bad thing. sometimes as brokers, we tend to say, come on, like this is taking a lot longer than it should. But I think that people are very smart to make sure that they're making a good choice. And we're there, I see it with our professionals a lot. We're there to really be their advisors on that front and help them work through those questions. And use the tools that we have available to us to kind of help them make smart choices.
So I'd say, Stephanie, over the last year since you've been here, the biggest change in the industrial market is from the investors, just the change of interest rates, change of how you said it, analytics, the change of how they're analyzing deals is completely different than what we had seen before. Where would you say the focus is today for industrial investors?
Geographically, or just kind of in those different
I'm saying
analysis?
I'm saying that like their focus on what are they looking at, what are they buying, what are they shying away from, what are
Yeah.
investors doing?
I think we're seeing a lot more of the mark to market opportunities. So where if
Mm.
they're trying to acquire an asset, are the existing leases rolling in the near future, and can we mark those to market and really grow the rents there because they're significantly below market? So that more value add opportunity, I think, is more appealing to people. There's still a lot of focus on those, high barrier to entry markets, some of the port cities, not as much velocity in the tertiary markets. But, we're still seeing some pretty low cap rates in certain places that where others that's in question. So, in Las Vegas, we're seeing some low cap rates. Southern California, like the Inland Empire. So it's really market by market, but they're looking at those opportunities where they can grow their rents and buy something at, today's prices where they can grow the rental stream in the future. Those are probably the biggest trends we're seeing on the buy side.
Yeah, it's interesting to see that, long-term leases, long-term wall is just about impossible to move. Like
Yeah.
you would think that people would be coming around, or certain, buying pool would be coming around and saying, gosh, we want stability heading into instability, but that is not the case. Like,
No.
there's been a lot of long-term great assets removed that just couldn't, people were unable to move them in the capital markets, and they're all sidelined.
Yeah. I remember a time, it was on the developer side, where we would sell our Amazon leased buildings, and the 10, 15-year leases.
Mhm.
And that was just, we were frothing when we had the opportunity to do those long-term deals. And then all of a sudden, 2020 rolled around and we started saying, we don't want these long-term deals anymore. And that was a Duke Realty position. That was Prologis. A lot of the larger institutions were starting to say, you know what, we're going to shy away from these long-term deals, exceptions being made for like refrigerated space or where there was a lot of investment being put into the box. But now that long waltz is not very attractive to people.
That's right.
So yeah, for sure.
Yeah, I think you nailed it on that, Stephanie. The money is focused on shorter term walt, and then in the core markets that you described. That's where the capital is today.
Yeah.
So on the occupier side, I know great exposure to what some of those occupiers are doing and what markets are hot. What are some of the top markets for occupiers so far in 2023?
That's a tough one to answer because I mean we're really seeing deals be done in lots of different places. They're still focused on where population is. I think in general, the occupiers are really evaluating their networks and seeing where they need to right size. And that could be, reducing footprint or expanding footprint. There are some occupiers who are still under allocated in a lot of major markets. We're seeing it a lot in the Sun Belt. So we're seeing, a lot of activity in the Carolinas, Georgia, it's Savannah seems to be still pretty busy. Atlanta, I'm hearing, might be getting a little softer. South Florida is still pretty busy with some larger requirements, but Dallas has done a lot of absorbing of space this year, as has Phoenix. And then the markets that really haven't absorbed that much space, I think it's predominantly because there wasn't any space to absorb. So I think, some people would still go there, but because there's not anything available, they can't.
So we're about halfway through 2023. What is your predictions kind of, in the second half of the year and the closing of the year on kind of overall U.S., growth in the industrial sector, rent growth, cap rates. Where do you think things are going to go for the balance of this year?
Well, if my crystal ball were only clear, but I can tell you based on some of the trends we're seeing and, some of the data from the first half of the year, I would say rental rates will continue to grow in most markets. So in those markets where there is still very low vacancy, where there's still high demand and, strong fundamentals, those rents will still grow. Some of our institutional clients are predicting, 8 to 10% rent growth this year, and they're sticking to that number as of now. And I don't disagree with that. There are some that are flattening out, but those are because there's just been an influx of new delivery to the market. So there's about 621 million square feet of industrial space under construction right now across the country. So I think that will lend itself, because there's a little bit of caution on the occupier side right now, and people are being more judicious about what they're taking down. We'll probably see a little uptick in vacancy, average vacancy across the US, but it's still a very healthy number. Even if we hit 5% across the country by the end of the year, I think ultimately that space will get absorbed. And that's predominantly due to the fact that a lot of developers slowed their development in the middle of last year when we started to see those interest rates climb. So I think we're just going to play a little catch up. So we'll see those vacancy rates pop a little bit, but I don't think it's anything to be alarmed with. I think we'll still be doing deals. As far as cap rates, I think that there are people who are looking to place capital. So, it's going to be slower than it has been, but historically, I think we'll be pretty close to where we were pre-pandemic when things got pretty frothy.
Yep.
So there's still a lot of question about cap rates going forward, but I think deals will continue to trade where they make sense.
Yeah, that's historically, if in fact we do go to 5% from a vacancy standpoint, you still look at that and that's still a really healthy
Yeah.
market, right?
Yeah.
The one thing I'll say that we're starting to notice across the country and in the occupiers that we work with, there are starting to be more concessions. Rates are holding firm and increasing as you talked about, but there is more free rent. There's some more TI dollars that are starting to take place in some of those transactions. So that's something we're going to continue to keep a close eye on. And then, of course, debt is always an interesting one to watch as we head into the second half of this year. Matt and I are really busy on BOVs right now. So I think that although the first half across the US has been kind of slow on the investment side, on the capital market side, we'll play a lot of catch up in the second half. Do you agree with that?
I do. I think it might be a slow ramp up, but I think by the end of the year, we'll see, more deals trading for sure. The Fed, I think I read an article earlier today where they're sort of evaluating what do they do next? Do they start pulling back on those interest rate increases because of the health of the banking, system? So it'll be interesting to see what happens with that in the next month or two and how that impacts, the decisions that people make on their real estate investments going forward.
Well, Stephanie, we want to thank you for being on the show. You have been a phenomenal addition to Colliers. Thanks for all you do. Thanks for your time on the road and all of our offices and promoting what Colliers is and what we're becoming. Thank you for being on the show. We greatly appreciate it.
I appreciate the invite. Thank you, guys.
Thanks, Stephanie.